Hello, everyone. My name is Christina Liu. I am a mental fitness coach. Thank you so much for joining me for this week's video where I share with you some tools and tips on how to build mental fitness. In the last two videos, I started talking to you about the concept of money and investing because I feel that it is an area where it really could trigger a lot of our saboteurs or that survival part of the brain. So I thought I would share with you some of the philosophies and ideas that I have learned over the years that hopefully can help you to embark on your or continue on your investment journey so that you can make money work for you, so that you can get those basic needs taken care of, so that your attention can be more on a higher level needs such as self-actualization. Now, this week, I would like to talk to you about the concept of asset allocation, which is a really important concept. And in one of the books that I shared with you, in Money Master the Game, Tony Robbins, when he interviewed 40 of the biggest investment experts in the world, they all have mentioned that asset allocation is one of the most important things that you need to learn when it comes to investing. And what is asset allocation? Another word for it is basically diversification. So basically meaning not to put all your eggs in one basket when it comes to investing. So basically don't put all your money into this one particular stock or this one property or this bond or any one type of asset, but rather diversify it across a portfolio of different assets. And what are the most common ones that people know of that we can invest in, that we can invest in easily and that can give us pretty good returns? So the first one that probably a lot of you can think of is stocks. So all it is investing in companies, right? Another one is in bonds. So this is debts that companies or government issues. And then the third is real estate. So buying a house, a condo, an apartment. And then fourth is, I can think of, is gold or precious metals. And then the fifth one that has become more and more popular in the last 10 years is cryptocurrency, which the most popular one is probably Bitcoin. And of course, there are other types of investments, such as you can invest in wine or art or maybe antique cars. But those are, I personally don't invest in them. And I do think that they're a little bit harder to get into, and the value is perhaps a little bit less easily defined, right, than some of these other ones that I mentioned. And so I'll just focus on those 5 classes. So let me share with you, a screen of where I put my money or how I allocate my assets. And this is by no means the right way, or this is what I think you should do. This is just an example what an asset allocation could look like. And so you can see the majority of my assets is in stocks. So that's like almost 70%. And this is across individual stocks as well as mutual funds and ETFs, or exchange traded funds. So all it is, so mutual funds and ETFs, so I still put it into the stocks asset class because they're just ways for you to invest in different stocks. And mutual funds and ETFs are great ways to invest in stocks because they allow you to diversify within that asset class. So that's the reason why you might want to invest in mutual funds. And then bonds, so I have a little bit of that as well, about 6% now. And that is also in mutual funds and ETFs. So I don't invest in any individual bonds. And then I also have some real estate. So this is another way that you can diversify within the real estate class, is by investing in real estate investment trust, or REIT. And then I also have a couple of my individual properties. So this category of real estate has gone up in the last year and a half or so since I bought my property in Peru, which I've turned into a lodge and retreat center. And then I also recently bought a house here in Breckenridge, which I live in Colorado. So but for a long time, I didn't have any individual properties. And that's kind of been my kind of philosophy, because I feel that when you invest in an individual property, you're tying down a lot of money. So, usually you have to put about 20% or at least 10% of the property value down before you can buy something. And so that's a lot of money tied in. And real estate is probably, out of all these categories, is probably the least liquid of all the assets. So when I say liquid, it means, or at least liquid is, it basically means you can't just decide to sell a piece of property and expect to get that money the next day or even the next week, right? It takes a little bit of time to actually get your money. So if you need the money within a short period of time, it's not really a great way to put your money. Whereas when you invest in REIT, it's basically a mutual fund. So I invest in one at Vanguard, and it acts very similar to any other mutual fund of stocks or bonds. So, you can sell it and then get the money to your bank within a few days or a week at the most, right? So it can still be more liquid. And then I also hold a little bit of gold and precious metal, and that is, I also put it into a mutual fund, an ETF. So I don't invest hold any gold like in my bedroom. So that's why I believe mutual funds and ETFs are great ways to get into a particular market with quite low risks, because the definition of a mutual fund and ETF is it has a basket of stocks or bonds, or in this case gold, in the portfolio. So you're already achieving that diversification. And I mentioned the name Vanguard. This is an investment company that I use. It's an investment vehicle, and it's very easy. That's one. And the other is it has very low fees when it comes to all these mutual funds and ETFs. So most of my funds now they have an expense ratio. So this is the fees that we're talking about, of 0.0405%. So this is very low, much lower than the industry average. So that's why I recommend Vanguard to everyone. I'm not getting paid from them at all. It's just I've had a great experience using them in the last probably 17 years I've been investing with them. And then the latest investment that I have is cryptocurrency. So I only started getting into it in about 2017. And that time, the Bitcoin was about, I think, around 4,000, maybe 3,000, close to $4,000. And I already thought maybe it's a little bit high, but let me just use a little bit of my assets. So I allocated maybe about 1 to 2% of my overall asset into buying some Bitcoin. And now it's gone up to about 5% of my overall portfolio, because if you have been following Bitcoin, the latest price, it's at about 47,000. So it has gone up quite a bit in the last 3 years. So 3 years, 10 times return, or more than 10 times, 11, 12 times return. That's pretty good. So generally, you're not going to see that kind of return in the stock market or bond market or any other market. Well, of course, there are exceptions, but generally, right, if you invest in kind of an overall total market, kind of a mutual fund or ETF, you're not going to get that. So that's a good thing about crypto. But, that's not the majority of my holding, because I do think it is quite risky. Although if you want to know my view, I do think it's there to stay, but of course there is risks. So that's the thing about asset allocation is, you may ask, what's the right portfolio or what's the right ratio to have? It really depends. It depends on your risk appetite. And also another really important factor is, when do you need the money? If you need the money, tomorrow or even next year or within 5 years, I would say that's very short term. So if that's your horizon that you need the money in, then you might not want to put it into something risky, because the chances of it going down within a year is actually quite high. However, if you do have at least 5 years or 10 years or 20 years to wait, then the chances of it going down in those 20 years, there is a chance, but it is very, very low. And this is just based on what has happened historically. And of course, may say, you know, what happens in the past doesn't define the future. And this is something I learned in business school in a decision-making class. However, here, I think in life, it's all about probabilities. So do you want to bet on the chance of, you know, in 20 years, the stock market going down, you know, based on that, you know, 1, 2, 3%, 10 or chance of it happening? Or do you want to bet on, you know, 90, 95% chance that it will go up, right? So yeah, so this is my portfolio. You know, you may say, wow, that's too much heavily weighted on stocks, and you want to do something a little bit more conservative. So generally, if you have more bonds in your portfolio, it is more conservative. You might get less return, but also the chances of it going drastically down is also much lower. Or you might look at this and you say, hey, I want even more stocks in my portfolio, and that's great. And so basically, whatever it is that you feel comfortable with, here what I'm saying is come up with a strategy. It's good to think about these things, about how you want to allocate things, thinking about, you know, what's my risk appetite and when do I need the money? And when I say when you need the money, is usually when do you need to retire? Or, you know, when do you have a big life event like buying a house, or, you know, using it for kids' education, or any other, or maybe like in my case, you know, I became an entrepreneur from having a steady, secure corporate job. So I needed to some of the investments a couple of years ago to basically fund my my entrepreneurship, and not having a lot of income for a couple of years. And so I was totally fine with selling some investments during these circumstances, because that's exactly what they're for. However, if you don't need the money, I would say my philosophy is, and a lot of the experts will tell you, don't sell your asset holdings. So I also want to show you just a chart of what the market does and why it is, it's a good idea to hold something for a long time. So this is the S&P 500. And so when we talk about the market, usually we're talking about the S&P 500, or we could be talking about any other indices like the Dow Jones or the NASDAQ, which is what we talked about last time. And these are all US indices. And if you live abroad, you have your own indices. And I'm sorry, I'm not that familiar with them. So here I'm just going to use the example of the S&P 500 and a couple of the other US indices. So this is on a 1-year horizon. You see how there are small ups and downs throughout this chart, right? And then there's as you see here, there's a big dip. And this is what happened when coronavirus hit at the highest. And so this is what happens to a stock, you know, or to an index and to an individual stock on a period of time. And so this is just 1 year. And then if you look at a 5-year horizon, it's similar. You know, there are small dips, ups and downs, you know, ups and downs. And so one stock advisory system that I use, it's called Motley Fools. And I also like them very much because I very much align with their investment philosophy, is that they say something like every year that the market might go down by 20% at a point of time. So not overall during that period of time, but at one point of time, it could go down by 20%. And every 3 years, it could go down as much as 40%. So that means the market fluctuates and individual stocks will fluctuate. However, if you have a long time to wait, right? Let's say you invested in something in the beginning of 2016, and by now you would have 105% return. If you just invested in a S&P 500 index mutual fund or ETF. So that's doubling your money in 5 years. And you can say, is that good or bad? You know, I think it's pretty good. You know, if you can do this consistently, you know, over a 30, 40-year period that you work and invest, you know, last week I showed you can get some pretty sizable returns by the end of, you know, in your 60s when you need to retire. And so this is the S&P 500. So here you see that the the index went down from, this is at the highest of 3,300 to at the low of 2,300. So that's over 30% down, right? But it rebounded. It rebounded within about 5 to 6 months period. And this is the S&P 500. If you want to compare it to NASDAQ, which is something a little bit more risky, this is mostly tech stocks. You can see it kind of follows similar patterns, right? So that's why when we say the market, generally all the indices kind of follow each other. However, what the NASDAQ has been able to do since the coronavirus rebound is that it has gone up even at a steeper curve. And so if you invested, let's look at the NASDAQ, if you invested it in the beginning of 2016, and by now you would have had over 200% return. So that's 3 times what you put in. I think that's a pretty darn good investment return. And then if you look at the Dow, that's 30 of the most represented stocks in the US economy. This is the yellow line. You can see the curve is much less steep than NASDAQ, but it kind of follows similar patterns, right? So I guess what I'm trying to say here is, that's why I truly believe in long-term investing. And I know there might be some short-term investors out there. And I know you could also make some really good returns. However, I guess for the average investor, there are several hurdles. One is that you have to put a lot of time into it, right? And most of us are not full-time investors or traders. And we don't have so much time to understand what the stock is doing and all of that. So it might not be so easy to execute. And the second reason is actually based on research. On average, short-term investors don't get as much return as long-term investors. So that's on average. Of course, there are exceptions. And then the third is, I would say, when you buy and sell a stock within the year, or any kind of investment within the year, the gains that you get, at least in the US, is taxed at the ordinary income rate, whichever bracket you're in. And usually, people, if you make a good amount of money, you will be at the 28 or even 35% bracket. However, if you hold it for more than a year, you would get taxed at the capital gains rate, which is, I believe now it's still 15%. So it's much lower, right? And then the other thing is short-term investing requires you to make predictions about an individual stock or about the overall market. And when Tony Robbins did his interviews with all these investment experts, every single one has said that they cannot predict the market. So they have no idea when the market is going to hit bottom or when it's going to start to hit the bottom, and then whether it's going to continue to go up. Now we're seeing the NASDAQ is going up it's at an all-time high. How long is this going to go on for? We don't know. Nobody knows. And so to think that you can predict the market and make some moves based on these predictions, it's probably the chances of you succeeding is quite low. So therefore, and what is long-term investing? It's basically following this chart. If we're talking about here holding something for at least 5 years, this is basically what you're doing. You buy something, here is at the beginning of 2016, you do not touch it for 5 years. And so look at what it's doing. Yes, there are down times during the market, during coronavirus time, it went down 30, 40%. Yes, there are times like that. However, if you hold on to this strategy and say, hey, I believe in the overall stock market, I believe, or if you invest in individual stocks, I believe in this company, then you hold on. You don't do anything. And you can see over a 5-year period, you can get anywhere from doubling your money to tripling your money. Or if you invest in an individual stock, for example, Apple is probably my biggest holding, individual stock holding. It has done in the 5 years. So this is 463%. So more than 5 times return, 5 years. And did it have its downs during these 5 years? Absolutely. Look at all this. It had many downturns, lots of them. But if you believe in their overall fundamentals and you believe in the company, then you hold on and you don't do anything during these down periods. So, there is a saying called buy low, sell high, which, if you hear about it, it makes a lot of sense. That's basically how you make money, right? Um, and however, what do most investors do? They actually buy high, sell low. Why do they do that? Because we talk about this concept of the saboteur. Fear comes in, emotion comes in, and fear makes you not stick with your strategy, not stick with, these charts of what is the highest probability of things happening, and makes you panic and makes you react to what is happening to the market. So for example, when coronavirus hit, maybe a lot of investors started selling. They saw the market go down and they say, oh my gosh, I don't believe in the market anymore. I don't believe in this stock anymore. And so they sell. However, look at what happened. Like, for example, Apple, it rebounded within less than 3 months. It rebounded to the pre-coronavirus um, position, and then it continues to go up. So that's why I guess what I'm telling you here is I am a believer of long-term investor, and I do think there's plenty of data out there that shows you how this can be a great strategy, especially for investors who don't have a lot of time to look at the market every day and buy and sell. Because when you're a long-term investor, you buy once or you do some periodic investments. You can make it even automatic, and basically that's it. You don't have to spend a whole lot of time on it at all. And so yeah, so hopefully this gave you some ideas and just some of my views about investing and asset allocation. So again, it's don't put all your eggs in one basket, diversify. And then the other is to hold your investment for a long period of time. Hold it until you need the money. Right? Or hold it until you really truly don't believe in the fundamentals of that particular company or maybe of this particular market. And even then, sometimes I feel like when you make that decision, you really need data to back it up. Because I myself have sold some stocks that I have bought, like Alibaba, for example. Like I bought it and then it went down in the first couple months, and then I said, oh, maybe I can't believe in this Chinese company. There are a lot of risks. And but then now I kind of wish that I held on because the company has been doing really well. And I knew I believe in their fundamentals, but I was one of those that reacted to what was happening to the market. And that's okay. We all make mistakes, as it's with anything in life. And and when it comes to investing, yeah, we make mistakes. But the important thing is to learn from those mistakes. If we use the theory of the sage will look at anything that happens as a gift and opportunity. So I'm actually really glad of all the mistakes that I have made. At one point, I think in 2016, I saw the market going down and I thought, oh my gosh, what if another 2008 happens? And maybe I need to sell it now and then buy it again when it bottoms out. And then actually it never bottomed out. It continued to go up. And then so I said, well, what am I going to do with all this money now? So then I rebought all the investments that I had. And in the process, definitely lost some money. So from that experience, I don't do that anymore. Now, when I see a market downturn, I basically, yeah, it still gets me a little bit nervous and anxious, but, those saboteur feelings. But, I kind of sit with it and trust that what I have learned over the years is the right thing. I continue to follow the right experts like Motley Fools. They have some really great recommendations of stocks and of investment strategy and philosophy. So I continue to read those and follow those strategies and stay with it and not panic and not react based on emotions in a short term. So Well, thank you so much for watching, and I would love to hear your feedback and your comments, and what do you agree or disagree, or any other topics that you would like to hear about in the future. And also, I am on Clubhouse. This is a new kind of an app that you can have conversations with different people. So I've been having some conversations with people. Last week I had, or this week actually, I had one with some of my the people that I met at Day with Destiny, a Tony Robbins event, and we had a great discussion. And next week, Tuesday, I'm going to have another one with two of the people that I did a podcast with today. I'm talking about biohacking, about mindset, and also psychedelics. So that's coming up next Tuesday. So I would love it if you could follow me on Clubhouse and join in to some of these conversations. And it's much more active, interactive. And so it's quite a great app. I quite enjoy it. So hopefully many of you can join as well. All right. Well, thank you so much for watching, and I hope to see you next week. Bye now. Take care.